Welcome to stock valuation. Stock valuation is the process of determining the intrinsic or true value of a share of common stock of a company. It helps to find the value of a common share which is justified by the company earnings and growth potential. It also helps to identify the undervalued and overvalued stocks. For example, an investor wants to invest in some shares of a stock. Before investing in stocks, they must predict, they must determine the future price of the stock, the future cash flow of the stock, the undervalued and overvalued of stock. Undervalued means suppose your stock intrinsic or true value is $100, but it is selling in $50, then it is called undervalued. Conversely, if your stock intrinsic value is $100, but it is selling for $150, then it is called overvalued. So these things should be identified, should be determined before investing in stocks. That is why stock valuation is very important for the investor. A share of common stock is more difficult to value in practice for the below reasons. The first reason is that with common stock, promised cash flows are not known in advance. You cannot absolutely say how much you will receive in your upcoming period. The second one is the life of investment is essentially forever because common stock has the maturity. It lasts forever. The third one is that there is no way to easily observe the rate of return that the market requires. Nonetheless, there are also some cases in which we can come up with the present value of the future cash flows for a share of stock and thus determine its value. So in some cases, we can determine the share value through calculating present value of the future cash flows like dividend payment, other capital gains. Cash flows for stockholders. If investor buys share of a stock, then they can receive cash in two ways. One is through dividend, another is through selling shares to another investor in the market or back to the company. Like bond, the price of the stock is the present value of this expected cash flows. So you can determine the price of the stock through the present value of the expected future cash flows. Some investors invest in shares of stock for the desire of dividend. Some investor invest in stock for the desire of capital gain. It depends on the investor investing policy. We can make these things more understood through some examples. At first, we can see the one period example where it says that suppose you are thinking of purchasing the stock of Muri Oil Incorporation. You expect it to pay a $2 dividend in 1 year, and you believe that you can sell the stock for $14 at that time. If you expect it to pay, if you require a return of 20% or investment of this risk, what is the maximum you would be willing to pay? So here your dividend in first year is $2. At the same year, your stock price is $14. And required return on investment of this risk is 20%. So now we have to find out what is the maximum you would be willing to pay to buy the stock of Muri Oil Incorporation. So now we have to calculate the present value of expected cash flows. Your expected cash flows are $2 dividend in 1 year and selling price of $14. Let P0 be the current price of the stock and assign P1 to be the price in one period. If D1 is the cash dividend paid at the end of the period, then P0 equal to D1 plus P1 divided by 1 plus R. Here P0 is the current price of the stock. D1 is the year 1 dividend. P1 is the selling price of the stock in one period. So here D1 is dividend in year 1, so which is $2. It is $2. Then P1 is the selling price of the stock, which is $14, divided by 1 plus R. Required return is 20%. So if you calculate, then we get the price of the stock 13.33. Through financial calculator, you can put 16, $2 in year 1, $14 selling price in year 1. Total 16 as future value. And your required return is 20%. Press 20 for interest. And number of year is 1 for N. And then press CPTPB, you will get 13.33. You can also put dividend payment to as PMT, which is periodic payment, and 14 selling price as future value. However, now we can conclude that if you buy the stock of Muri Oil Corporations at $13.33, after 1 year, its value will be $14. So this way we can value stock of in a company. Here is another example, which is for a 2-period example. Now what if you decide to hold the stock for 2 years? In our previous slide, we have shown the example for 1 period. Now if you decide to hold the stock for 2 years, in addition to the dividend in 1 year, you expect of $2.10 in 2 years. That means in year 1, you expect dividend $2. In year 2, it is $2.10. And the stock price of 14.70 at the end of year 2. Now, how much would you be willing to pay? So, according to the formula, D1 by 1 plus R, it is for first year price calculation. D2 plus P2 divided by 1 plus R power 2, it is for second year stock price calculation. So, in year 1, your dividend payment is $2. So D1 241 divided by 1 plus, as we have already seen that our required return is $20 in our previous example. So 1 plus required return 20%, 1.2 plus second year dividend, which is 2.10, plus stock price at the year 2, at the end of year 2 is 14.70 divided by 1 plus required return 20% power 2. You have to make sure that you are calculating your selling price from the maturity period. Like here, your maturity period is 2. So you are calculating stock price with the end of the maturity period dividend payment. So you are summing up this. So after calculation, we get the result of 13.33. So similarly, if you invest 13.33 for buying the stock, after 2 years, the stock price will be 14.70. So using financial calculator, your cash flow in year 1 is 2. Your cash flow in year 2 is 14.70 selling price plus 2.10 dividend. So in total 16.80. Then press NPV, 20 required return for I, interest rate. Then press CPD NPV, you will get the same result. Now, 3-period example. If you decide to hold the stock for 3 years, what will be the stock price? In addition to the dividends at the end of years 1 and 2, you expect to receive a dividend of 2.205 at the end of year 3. The stock price is expected to be $15.435. Now, how much would you be willing to pay? So according to the formula, D1 1 plus R plus D2 1 plus R power 2 plus D3 plus P3 power 1 plus R power 3. So in year 1 dividend is $2, you know that, divided by 1 plus record return 20%. Then second year dividend is 2.10 divided by 1 plus a record return 20% power 2. It should be power. It should be power. Then for the third year, dividend payment is 2.205 plus stock selling price at the end of year 3 is 15.435 divided by 1 plus record return power 3. So if you calculate this, you'll get the same result, 13.33. So here you can also see that the selling price at the end of year 3 is added with dividend at the end of year 3. So always the selling price should be added with the last year dividend. Using financial calculator, year 1 dividend 2 for C01, year 1 cash flow, year 2 dividend 2.104 C02, year 2 cash flow. Then year 3, your total cash flow is 15.435 plus 2.205. So altogether it is 17.64. So in year 3 cash flow is 17.64. Then press NPV 20 record return for I. Then press CPD NPV, you will get 13.33. So if you invest 13.33 today, after 3 years, the stock price is expected to be $15.435. Meantime, in every year, you will receive some dividend. In first year, you will receive 2 as first year dividend. In second year, you will receive 2.20. In second year, you will receive 2.10 dividend. In year 3, you will receive 2.205 as dividend. So here you will have dividend as well as capital gain from buying and selling price difference.